Hey everybody, Brian Burke, President and CEO of Praxis Capital, here to talk to you today about the PM Multifamily Value Fund 5. We got a great webinar for you here today and should be wrapping this thing up in 45 minutes to an hour. Hopefully, if I get through it quick enough, I'll even have some time to answer a few questions. So there's a chat window on the side of the screen. You can type questions in there, and if for any reason we aren't able to get to all the questions today or don't have any time for questions because I talk too much, we'll make sure that we answer all those questions in email after the webinar. So welcome. Thanks for coming and being a part of it today. Really glad to see such a great turnout. We have a few things to go over today. We'll start with just an introduction to Praxis Multifamily and our PM Value Fund 5. We'll talk about Praxis Capital and our team and track record, what our acquisition strategy is. We'll get into the market a little bit as well. We'll talk about the initial fund assets that we're going to acquire in the fund. And then finally, we'll end up with how to subscribe to the fund. And if for some reason you can't make it through the whole webinar, in about 3 hours, you'll get an email with a link to a replay, and you can watch this webinar on a replay. So no worries if you can't hang out for the whole time today. So we're raising the PM Multifamily Value Fund 5 is raising up to $50 million for the purposes of buying multifamily assets, and we'll get into our acquisition strategy here in a bit. Our target returns are a 14 to 16 IRR, average cash on cash in the 7 to 8 range. Of course, these are value add assets, and in any value add scenario, the year one cash on cash is usually pretty low, and we don't expect that to be any different here. We're targeting equity multiples in the 1.7 to 2x range. We're bringing 5% of the capital in alongside our investors. And you might be asking, why are we doing a webinar? And our investors that have been with us for a while probably have realized that we don't do a lot of webinars. And one of the reasons for that, or the primary reason for that, is it takes about a week to put these webinar slides together. And one of the problems that we've had here at Praxis is when we launch an offering, it's usually fully subscribed with a waiting list in about 24 to 48 hours. And so we haven't had a chance to do a webinar because of that reason alone. But so you might be asking, are you guys desperate to raise capital this time? So this time you're doing a webinar? That's not it. We've got a lot of interest in this fund, and how much of the 50 million we'll raise, we don't know. Bob tells me that the amount that we raise is directly proportional to how badly I screw up this webinar. So I guess the test results will be out soon. But one of the reasons why we're doing this webinar as well is we want to answer the big looming question that everybody has, which is, why are you doing a fund? That's kind of the big question we've been getting, and it's a great valid question. This isn't the first time we've done funds. We've actually done about 7 of them in the past. A lot of these were in the single family space. We've done a couple multifamily where we've done multi-asset, identified asset syndications, which are considered funds to a certain extent without the discretionary component that we have in this fund. But in the 20 years, or I guess it's 18 years, we've had discretionary funds. We've acquired over 700 properties in funds with discretionary money. And so far, we've never lost anybody's capital. So we feel that we've got the fund side of the business down right now. And part of that is because we are probably going to be selling 1,000 units next year. And of course, we're using that as leverage with our brokers to say, if you want this listing, you've got to bring us an off-market deal we can buy, and that's helping us expand our deal flow. So that's kind of another reason why we're doing a fund. But there's a host of reasons why a fund, is both good for us and good for the investor. For us, we just identified the issue that our funds, our single asset syndications were regularly oversubscribing with a waiting list very quickly. We have a lot of investors that invest in every offering that we do, and sometimes they would get shut out because we get a call and say, I didn't check my email for a day, and I missed the whole opportunity. And we'd like to find a way to mitigate that problem. Of course, the increasing deal flow is another. And then for the investors, one of the things that you get with a fund is you get some property, at least property, and perhaps even geographic diversification, which is a plus. The other plus is cost efficiency. It costs $10,000 to $20,000 to put together a Reg D offering, and with doing a fund, we can spread that cost over multiple assets, and that allows us to get some cost efficiencies. And finally, the last point is it's both good for us and good for the investor, is it enables us to be more competitive when we're buying. And, we're only buying in highly competitive markets, and we'll talk in a minute on what markets we're focusing on and why. But when you're in these competitive situations, you always end up in an interview call with sellers, and they want to know, where are you getting your equity? Where's the money coming from? And our answer has always been, we raise it from our client base, and, we've got a really good track record of doing that. Our assets or our funds usually oversubscribe in 48 hours. And that's a great story to tell, and everybody knows our track record and history, and it usually hasn't been a stumbling block. But if you're competing against someone who says, oh, we have a fund and we have callable capital, it puts us at a disadvantage, and we've lost some really good opportunities as a result of that, and this will help fix that as well. The main disadvantage to a fund is the investors can't see what assets the fund will purchase. Our solution to that is we've identified 2 assets that are going to go into the fund immediately. We have 2 properties in contract, and those will be the initial fund assets. Now, they might be the only fund assets. Again, if I screw this webinar up really badly, we'll only raise enough money for these 2, as Bob is telling me. So the goal here is to raise enough capital to close on the 2 deals that we've already got in contract, and we've already soft circled enough capital to do that. And then, as we raise additional capital beyond that, that gives us some discretionary funds to acquire 1 or 2 additional assets. So why invest with Praxis? I think the biggest reason is just our track record of having no investor losses. And we've been able to do that throughout market cycles. Plus, we have a very deep, experienced bench. I'm going to go into the principles and who we all are here in a minute, but when you add everybody up together, we have over 100,000 units of multifamily experience going back as long as 40 years, $5 billion of transactional experience, but, again, no investor losses. As we've built this firm up, we've developed complete institutional grade architecture for property and asset management, and that gives us some great portfolio advantages as well. So on the team, you got me. Unfortunately, you're stuck with me for the next few minutes, but I've been investing in real estate for over 30 years now. On the multifamily side, over 2,500 units. It'll be over 3,000 here. Once we close escrow on the assets that we have in contract. Jeff Silverman's our chief financial officer. He's got 30 years in multifamily and 45,000 units of experience. And Forrest Corral, he's been in it about as long as I have, maybe just a little bit less, but he's got over 20,000 units of experience. And then we got Lyle Lansdell. He's the CEO of our wholly owned property management company. Lyle's been in multifamily for 40 years, over 40,000 units of experience. He started our multifamily management platform for managing our assets, and he's done that 6 times in his career for major institutional players. Now, these guys that aren't on this webinar with us, Jeff, Forrest, and Lyle, they've all worked for big name shops of names that you would recognize in the institutional world. And they brought all that those skill sets and relationships to Praxis. Then, of course, we got Bob Dreer. A lot of you guys know Bob, and if you don't know Bob, he sent you the email that got you onto this webinar. So Bob is in charge of investor relations here at Praxis. He's the perfect one to talk to you guys about real estate and how real estate fits in with your overall investment portfolio, because he came from a securities background as a stockbroker, but also has a real estate background as a CCIM candidate and a business M&A background and a retirement plan specialist. So he's got a lot of skills on the investor side, and he really helps to kind of talk to people about how these real estate investments tie into your overall investment portfolio. Now, hopefully you'll get a chance to meet Bob one day, and you might run into him at a conference. But I got to warn you, if you're looking for Bob and you're at a conference and you're looking for Bob, do not look for the guy in this picture, because you won't recognize him. If you want to look for Bob, you got to look for this Bob, because I can tell you from experience, being that I'm in the office right next to him, you never see the guy without a Hawaiian shirt. Now, our operational experience with this whole team spans essentially across the whole country. This is kind of just a breakdown of where we have experience, and our primary markets of Arizona, Georgia, and Florida. You can see that those markets we've got 11,000 units in Georgia, 7,000 units of experience in Arizona, 6,800 units of experience in Florida. So certainly a deep bench of experience in the markets that we're specifically focused on. Company-wide, we've got $250 million in assets under management, over 800 investor positions, and 36 previous investor offerings. One of the things we're most proud of, though, is our high reinvestment rate. A lot of our investors invest in multiple offerings with us, and some invest in every offering. Our current portfolio is in Arizona, Texas, Georgia, and Florida. The highest concentration we have right now is in the Atlanta MSA. We have assets we've had or have assets in all of the major Texas metros. We're in Tampa, Florida, and certainly looking to expand in that market, as it's one of the strongest in the country. How do we manage all the way across the country is a common question that we get. Lyle is the CEO of our property management company, and on Lyle's team, we have Jeff Silverman, who's a dual role CFO with Praxis Multifamily and PM Residential Management. We also have Chris Stevens as our Chief Operating Officer. Lyle and Chris have worked together for over 30 years in various companies. Chris is in charge of a lot of day-to-day operations at the property level, as well as Amy Clark, our area vice president in Atlanta. We actually have staff all over the country. Our vice president of renovations, Carlos Olmo, is based out of Florida, and then Lyle and Jeff are based out of Southern California, along with the accounting team that keeps track of all the rents and expenses, all out of our Southern California office. A couple quick case studies. Whispering, these are our two most recent sales. Whispering Oaks was our most recent exit. That generated a 27.6 IRR and an 11.55 cash-on-cash return, and the property was a top 3 finalist for the Houston Apartment Association's Property of the Year in 2017. Elm Grove was another recent sale. We sold that a year ahead of schedule. That generated a whopping 28.7 IRR. I don't have any exits recently to show what we expect performance to look like today. These assets were acquired a few years ago, and we've definitely had the benefit of the upside in the market. We don't forecast going forward that returns are going to look anything like this. We're shooting for mid-teens returns, and if the market helps us, we can go a little bit higher. Multifamily has been an attractive long-term investment for years, and it's if you look at historical returns on 5-year holds of a variety of asset classes from 1987 to 2016, there are a couple PhDs that did study on this. Apartments had the highest returns out of the categories of apartments, retail, industrial, and office, and also had the highest returns per unit of risk among all property types, which makes multifamily a really attractive investment. One of the reasons why it's our main business focus. One of the reasons why I think that's happening, and it will continue to happen, is average household incomes are going up. You can see that with this light blue line on this chart, but average household sizes are going down, as you can see on the red line of that chart. So, as household size gets smaller, they tend to gravitate towards multifamily more than they would if household sizes were larger. And as incomes go up, they can afford to pay more rent. And that supply and demand dynamic is, on a macro level, is really affecting the apartment market. Our fund's acquisition criteria, we're looking for 100 units and up. We prefer 150 and up, and we really like 200 and up. Property types, we're looking for Class A minus and B properties. We will consider some Class C that we can reposition to Class B. We're not really looking for Class A plus. There are some opportunities out there in A plus, but right now we're looking more in value add. So that brings us to A minuses that, maybe a 2005 built property that is ready for a facelift. We want well-located and underperforming value-add multifamily assets. We always have to have some kind of value-add component where we can increase the income of the property so that we can produce the best results for our investors. How we acquire these, our acquisition process is actually pretty involved. We'll get over 500 property leads for every one acquisition that we complete. And so the funnel basically is like you take 500 properties, you underwrite 100 of those, the other 400 get tossed aside very early. Out of the 100 that you underwrite, if you're lucky, you'll find 10 that are worth writing an offer on. And out of those 10, if you're lucky, you get one acquisition. And there have been times where we've had to double this number in order to get one acquisition. And there, of course, are times where it doesn't take quite as many. Right now, our hit rate is improving primarily because we're getting a lot more off-market transactions. Our hit rate on marketed transactions is almost zero now. Almost everything we're buying is off-market. Our fund is targeting the markets in Nevada, Arizona, the Carolinas, Georgia, and Florida. These are the areas of the country where people are moving to rather than moving from. There's an interesting chart that came out from Bloomberg and when they did an analysis of showing kind of where people are moving away from and where they're going to. And certainly New York and California, Chicago are leading the pack for exits. And people are moving to Phoenix, Dallas, Tampa, Orlando, Atlanta, Las Vegas. These are top markets in the country where population is going. And when you look at cycles, everybody's concerned about, where are we in this cycle? And there's two kind of cycles that we monitor. And one cycle is the economic cycle, which is relatively unpredictable, except for the fact the only thing that's predictable about it is that it's unpredictable. But it can turn on a dime, and they tend to have short cycle times from peak to trough. Then you have a demographic cycle, and a demographic cycle is one where you have population growth and people moving to an area and job growth and a real movement that's happening. And those cycles tend to be very slow. If you looked at a population chart of Buffalo, New York, you would have saw its population increase for 100 years. And then it turned around and started to decline, and it's been declining for over 50 years. So, those cycles are very slow to reverse, and they tend to be, very long and somewhat predictable. And, we feel that markets where people are moving to, like Phoenix, Dallas, Central Florida, Atlanta, Carolinas, Las Vegas, these are markets where they're likely to continue to have an influx of population that's putting demand on multifamily real estate and supports our thesis for investing there for the longer term. Part of the thing that's driving this, or maybe it's a result of it, is job growth. If you look at projected job growth over the course of the next couple of years, Orlando, Atlanta, Phoenix, Charlotte, Tampa, those markets are among those that are leading the country. Certainly Texas is also a strong player in all of these who's who lists. You'll get a couple Californias on there, like you'll notice San Francisco and San Jose, certainly really strong in terms of job growth. There's certainly a lot of housing demand. The regulatory climate makes it really undesirable to invest in those markets. And, despite the adverse regulatory climate, there's investors climbing over one another for those properties and bidding the prices to the moon. So we stay out of those markets, despite the fact they have really robust job growth. One of the reasons why I think you have job growth is so robust in these areas, here's a list came out from Chief Executive Magazine, the best states for business, with Texas and Florida topping the list. I highlighted in yellow the markets where we're searching for real estate, not only in the past, but where we're searching in the future for the fund. And interestingly, you'll find most of the markets are topping the Chief Executive Magazine list. And, at the very, very bottom of the list is California. I think it's 49th or 50th. And that's one of the reasons why we're not investing in California. But Chief Executive Magazine isn't the only ranking that I find interesting. The Census Bureau's fastest growing states, Nevada's topping the list on a percentage basis, followed closely by Arizona and Florida. The Carolinas and Texas are in there. Georgia, while it didn't make this top 10 list on a percentage basis, it's number 8 for the number of people migrating in. And a lot of that's being focused on Atlanta. The fastest growing metro areas, Dallas tops the list again. It has for quite a while. Phoenix and Atlanta and Orlando, Tampa, again, markets that we're specifically focused on. The reasons we're not highly focused on Dallas especially is the market there is just very heated, and everybody in the country knows it tops job growth, and they're bidding like there's no tomorrow. So we're sitting on the sidelines in Dallas. We've looked at a couple things in Houston. So far, nothing to report out of that market. Austin is another one that's a big job growth area, but again, really difficult to find quality value add assets that make sense if you properly underwrite them. And the competitive landscape is really kind of messy. Another one I think is interesting is the moving companies put out lists of where one-way truck rentals are going. So Atlanta and Phoenix topped the list from Penske Truck Rentals on one-way moving destinations, and of course our other cities, Tampa, Orlando, Vegas, and Charlotte, they're on this list as well. So certainly all the data is supporting that there's strong population growth in our target markets, and we expect that's going to continue. Atlanta, for example, from 2010 through 2018, they've added 663,000 people to that metro in 8 years. So it's pretty incredible what's going on over there, and that's throwing off the supply and demand imbalance in Atlanta. Let's talk about the properties that we want to buy initially in the fund. The first asset is called Friendly Hills. It's in the Atlanta MSA. It's 169 units, built in 1998. It's a B- property that we acquired off market for $16.8 million. This property and our second initial fund asset, which is called the Reserve, also in the Atlanta MSA. It's 252 units, built in 1988. For $23,940,000. These two assets are owned by the same seller. Nothing's really been done to them at all for the entire period of the seller's ownership. A lot of interior finishes in the units. The Reserves had a little bit of interior upgrade done to it with some flooring and appliances, but that's about it. So our programmatic interior unit renovation is very thorough, and it really pops and stands out in the marketplace. We're going to take these units to our standard on both of these two properties. Just about a little bit about our local Atlanta experience. As each of us individually all added together, we have 9,845 units of experience in the Atlanta metro. Our current portfolio spans 1,323 units across 7 properties, and we have 2 assets we'll be most likely exiting in the Atlanta MSA next year, and we expect that those assets are going to produce at or above our projected performance for those after it's all said and done. These two properties are about 17 minutes east of downtown Atlanta on the I-20. One of the first, Friendly Hills, is one exit from the I-285 interchange, and the Reserve is two exits from the I-285 interchange. That's a tremendous advantage for these properties. Their location is very strategic in that you travel one exit and get to that interchange. You can go along the 20 to go into downtown Atlanta, or you can go south on the 285 to go to the airport. And down by the airport, there's a lot of transportation and warehousing jobs, and manufacturing, film and TV is very big down there. Or you can go north on the 285 where you have more film and TV, plus you have some technology and medical jobs going north on the 285. So all very easily accessible from the location of these two assets. As an aerial image of Friendly Hills, you can see its proximity to the freeway. It's very close and easy to get on, so it minimizes travel time. Same with the Reserve. This is the larger of the two properties. Again, right near the freeway, perfect location for commuters. Our renovation plan is to spend $6,000 to $7,000 per unit to upgrade the interiors. We also have $1.2 million budgeted for Friendly Hills for exterior improvements and $760,000 for the Reserve for exterior improvements. Friendly Hills is a smaller property than the Reserve, yet the budget is larger, and primarily because it's ready for roofs. So we have it in our budget to replace all the roofs at Friendly Hills, plus do a number of other amenity enhancements like replacing the playground and improving the exterior amenities. With the rents at Friendly Hills, the rents are currently $869, although they're leasing out about $100 more than what their current in-place average is. So their average is being dragged down by some old leases that they're not keeping the older leases up to current market. So they're already about $100 below market, and then even their newest leases aren't keeping up with the competition, and then they're not renovated. So if you compare it to renovated properties, and we'll have a market study that'll be included in our package, you'll get to see all of this. After renovation, we project we'll be able to get those rents up to $1,130, which is a $260 increase, or 30%, which is pretty substantial. At the Reserve, they're at $814. Their current in-place leases aren't as far below their newest leases as they are at Friendly Hills, but still they're certainly seeing some increase on their new leases. Our post-renovated rents there are projected to be $1,040, which is a 28% increase over their current overall average effective. The comp set, on the other hand, is sitting at about $1,182. So even after we renovate, we aren't going to be the market leader. We still have other competing properties that would be priced higher than us to give us a little bit of margin. Speaking of margin, another area where we like to underwrite to margins of safety is in economic vacancy. And economic vacancy is a term that's combining all components of vacancy, such as physical vacancy, bad debt, leases that are below current market rate, concessions that you give to attract new residents, and non-revenue units, which are model units or employee units for your staff. We're currently underwriting these assets on a stabilized basis between 11.25% and 13.5% economic vacancy. Initially, when we're starting out, we're underwriting closer to 30%, and then we bleed that down as we renovate and stabilize the property during the first few years of ownership. One of the things that I think is important to note, and you'll see this when you get the underwriting package, which will come after this webinar, you'll notice that our first year income projections are essentially flat from the property's historical income. And it's not that we're not projecting that we're not going to see any increases in the first year. It's just that we underwrite to the worst case scenario of assuming that the income doesn't go up yet and it takes a while to get that income to come up, and it typically will. These renovations phase in over time, and it takes about 1 to 2 years before you really start to see the effect of it. Another area where we like to be conservative is underwriting our forecasted rent growth. This is an excerpt from an Axiometrics submarket report. Axiometrics is a third-party data study service that specializes in analyzing multifamily real estate and the associated data that supports that market, such as rent growth, occupancy, job growth, and all those different factors. You'll notice here that for 2020 through 2022, Axiometrics is forecasting rent growth in between 4.2 and 5.1% on an annual basis. The forecast in our underwriting is for 3 to 4% rent growth during those periods. And then after 2022, when we don't have any third-party data to support our guesses, we drop our rent growth estimate down to 3%. You'll also see, right below where those two arrows are pointing, the occupancy rate for this submarket is in the 94 to 96% range. So that bodes well when we're talking about underwriting to 11 to 13% economic vacancy. Another interesting tidbit, the submarket where these properties are located was ranked number 1 out of all 39 Atlanta submarkets for rent growth. And you can see this if you look at the red column for 2Q 2019. The rent growth in this submarket was a whopping 10.6%. We don't think that that's sustainable over the long term, certainly, and we're absolutely not underwriting to that. But it's just interesting to note what that market has been doing. Another thing is there's no new construction in the pipeline in this submarket. There's currently no units forecasted to be developed over the next 3 years that at least that anybody knows about. Financing wise, this is a big one. One of the things that is very important to us is that we not lose investors' money. And we survived the last great financial collapse, and the people that didn't survive were those that were over leveraged, borrowing too much, and had no margins of safety and just had too much debt. So we're very cautious about debt. You'll notice in our underwriting package when they come out, the returns that we're projecting in our underwriting package are slightly lower than the returns that we projected initially in the flyer that we sent out a couple of weeks ago, by 1% or so, not by a large amount, but by some. And the reason that was is we just got a little more conservative on the debt and dialed the debt back. And of course, all returns are a risk-adjusted return. And the higher you leverage, the higher the return. And of course, the less leverage, the lower the return. And we opted to go for safety and dial the debt back. And that, of course, dialed the return back a little bit. We're limiting the debt in the fund to 75% of the project cost, which is the purchase price plus the renovations that we plan to do. On our initial fund assets, we're actually only borrowing 75% of the purchase price. Now, in both cases, the lenders offered to loan us significantly more, in fact, about $5 million more than what we're borrowing. And, we turned that offer down and instead opted for less debt, which, of course, that requires us to raise a bit more equity. But we want to be here if there's any kind of an adverse cycle. We want to be here when it comes out the other side. Typically, our loan-to-value ratios are going to be less than 65% by year 2. On our initial assets, it's actually around 55% by year 2. I think one's 54 and the other's 56. Our default ratios, we're looking to contain our default ratios to less than 85% in year 1. And what the default ratio is it's a stress test that we use to see how far we can draw income down before the net income equals the debt service. So an 85% default ratio means that our income can go 15% below projection before we get to a 1-to-1 debt coverage ratio, which means the income equals the debt. It's an important stress test that we apply. These initial assets by year 2, our default ratio will be at 72%. So after we start to see some of those rent increases, we'll actually have a 28% margin of safety between our debt service and our income. So, certainly we can survive a pretty significant downturn if the need arose to do so. We use long-term floating rate debt. The reason we use floating rate is we like to avoid the large prepayment penalties associated with paying off fixed rate debt early. And that's no more prevalent than in these deals themselves. The seller had long-term fixed rate financing in place on one of these assets and is paying about $1 million to pay that loan off in penalties. And we don't want to pay $1 million in penalties. We'll take the interest rate risk. We have a long-term interest rate forecast from Bloomberg that actually is forecasting LIBOR rates to decrease. They're currently at about 2.1%. They're forecasting decreases to about 1.4% over the next 1 to 2 years. And then over the course of the following 8 years, they're forecasting LIBOR rates to basically return to where they are today. So interest rates are forecasted to be stable, yet we also purchase disaster insurance in the form of a rate cap. And what the rate cap does is it kicks in if the interest rate climbs above the strike price of our interest rate cap, and it protects us from a catastrophic interest rate movement. So we kind of get the best of both worlds, that we can insure our downside, and we can participate in the upside on interest rates. Tax advantages of investing in real estate, and the fund is no different. Of course, you get depreciation that offsets your income. Most of the syndications we've done so far have had zero or negative taxable income during the hold period, at least for the majority of it, if not all of it. The new tax law allows for bonus depreciation, where a lot of these components of the building can be written off immediately, which is a big tax benefit. Sometimes you can use it, sometimes you can't as a passive investor, but that benefit is available. We do a cost segregation analysis on our properties, which what it does is it allows us to accelerate depreciation on some of the shorter term components of the building, like appliances and carpet and landscaping and things like that. We can depreciate those faster than we could if we didn't do a cost segregation analysis. And then when we sell, you get capital gain tax treatment, which is favorable to ordinary income tax rates. We can accept retirement funds if you have a self-directed IRA, a solo K, or a pension fund that you control. We can accept those retirement funds, and check with Bob on the special procedures needed to invest that way. So to kind of wrap up from where we started, and again, if you have any questions, feel free to type them in the chat screen, and I'll do my best to answer those questions. So up to 50 million is what we're looking to raise. Again, if I did a good job today, maybe we get close to that. I have a feeling we're probably going to end up raising somewhere between 20 and 30. The initial fund assets that we're acquiring require 18.4 million to acquire those. So if we raise around 20, those two assets will be the only assets in the fund. If we raise 30 million, we'll have enough dry powder left over to acquire one more asset. Maybe we have enough to acquire 2 more assets. Regardless of what the answer is, we only plan to acquire assets that are similar in character to what we just showed you as initial fund assets. Value-add multifamily properties, more kind of like 80s and 90s vintage, maybe 2000s. There's a possibility there could be a 1970s vintage, as long as it doesn't look like it's from 1970s and it's 1980s. But we're really focusing on 80s and 90s, early 2000s value-add multifamily. That's really our focus. We're very concerned. Like our first job, I've always said this from my very first fund that I raised. I raised from my coworkers when I was in law enforcement. I had 28 cops as investors, all carrying guns, and they knew how to use it. And I knew my life was at stake if I lost their money. I still treat all of our investor capital that way. And, the big thing, my first job, I say this all the time, my first job is to not lose people's money. My second job is to make money. And, nothing is more evident of that than, we actually had, and another reason why we were looking to do a fund, we actually had a third asset in contract. So we had 3 properties to start out with for this fund. But the third property didn't pass our due diligence inspections. We take a very deep dive when we go to our properties after we get them in contract, and we examine everything. And we uncovered some things that were being concealed by the ownership of that property, and we discovered it. And as a result, sadly, we had to cancel that transaction. I would rather eat $10,000 or $20,000 in deal pursuit costs than put our investors in a bad deal. And in case you're wondering who pays that $10,000 or $20,000, it's us. We're the ones writing that check. The fund does not bear that cost. If we toss a deal out, that's our cost to bear, and we did. And that's just how we'd rather make sure that our investors are only going in investment that we would want to invest in ourselves, and in fact, we do. The investment process, it begins with a private placement memorandum. This document is going to be available in the data room early next week. The private placement memorandum will be accompanied by a slide deck. You guys are probably accustomed to seeing our typical underwriting slide decks that come out where they're probably like 30 to 40 pages. They show every bit of the financials of the property and how we arrive at the returns, and you can follow the income all the way from start to finish. You'll notice that the teaser flyer that we put out a couple weeks ago was lacking all that detail, and the actual fund offering package will not be lacking that detail. It's going to have all the detail that you guys are hungry for. We'll have all of that available next week, so you can dig deep into the initial fund assets and see exactly how we underwrote them. So Bob will send out an email notice early next week to notify you when the private placement memorandum and slide deck, along with our market study and our renovation study, will all be available in the data room. He'll let you know. If you don't see an email from him by, say, Tuesday or Wednesday of next week, make sure you check your spam folder. Sometimes our emails get stuck in your spam. You don't want to miss it, so watch for it there, or shoot Bob an email, and he can make sure that you get that notification. So when that's available in the data room, review that. You can give Bob a verbal commitment to let him know how much you want to invest. I think right now, we already have about $20 million in verbal commitments, so we know we're going to have enough to close on our initial assets, and we really would like to see that get closer to our $50 million goal. When we fund these, and I'm going to tell you in a minute how to subscribe, but I'll tell you now how we're going to fund it. It's going to depend a bit on how much we raise. Let's say if we cap out at $20 million, we're going to be calling for all of the capital up front. That capital will be used to close on the 2 initial fund assets. The fund will then close, and this will become a 2-asset fund. We will not continue to raise money after the fund closes. If we raise more, like let's say we raise $40 million, we'll be issuing a capital call for half of the investor capital. And those capital calls will be due within 5 days of capital call notice. We'll use those funds to acquire the initial assets, and then as we acquire additional assets, we will call for additional capital in stages to cover those acquisitions. I would like to think that by the time we get to the point where you would need to make a formal commitment, we'll have some idea of where we stand. If your question, if it's important to you to know how much you're going to have to commit or how much you're going to have to contribute initially, make sure you ask, and we'll tell you where we are and what we know as of that moment. The subscription process, we're going to accept subscriptions through October 15th. It's all completed online through our secure investor portal. Some of you are familiar with how this works. You'll get an invitation to subscribe from Bob once you give a verbal commitment. He'll send you a link so that you can go online and fill out your subscription agreement and questionnaire. And we'll in turn email you the agreement through DocuSign, which you sign, then we get it and we sign it, and then you're all set. All you have to do then is wait for us to issue you a capital call, which will come by email. And when we issue that capital call, you'll have 5 days to send your funds in, and we'll certainly work with you if you need some additional notice. The lines of communication here are always open. You can always send Bob an email or drop him a call, and we're happy to help you out in any way that we can. There is a replay of this webinar that will be available, and I have a couple questions coming in. I'm going to get to those next before we end, but I just wanted to let everybody know there is a replay available of this webinar. You'll get an email in about 2 hours or so that will have a link to the webinar. Once you're, if you want to watch it again, once you're in the webinar replay, there's a YouTube logo that's kind of like a watermark on the video. If you click on that YouTube logo, it will kick you over to YouTube to watch the webinar from there. Now, you don't have to do this, but if you do that, it will allow you to fast forward. So if you only wanted to hear like the last 10 minutes again, or it was just one point that I covered that you wanted to hear again, you can get to it quickly by clicking on that YouTube logo and watching the webinar through there. If you're just in the main replay screen, it doesn't allow you to control it. For any additional information or questions, contact Bob. His email address is here on the screen. There's also a contact form on our website. You can use that. Bob's direct phone number there is also there on the screen. Contact Bob and he'll get you set up either with a verbal commitment and then subscription agreements. He'll make sure you get emailed copies of the slide deck and PPM. So that's all I had to cover for today. I have some questions that have come in. Let me hit those as well. Joe says that I already answered his question. I must have been psychic, Joe. I'm not even sure how I managed to do that. Let's see. Shane is saying if an investor has allocated money to the fund but has not been deployed into an asset, what returns would they expect? Well, we're only going to call for funds that we're actually going to deploy at that moment. So if we aren't ready for the funds to use them for an asset, you'll still have control over those funds, and you can invest them in anything that's liquid enough to allow you to comply with a capital call. Having said that, we don't want to tie your money up in perpetuity. So our acquisition period for this fund is only for 2020. So if we don't have assets acquired by the end of 2020, we'll release any unfunded capital commitments from investors. So, let's say that you make a $100,000 investment, we've only called for 75,000. And you're holding that other 25,000. We're not going to hold that hostage for 5 years. We only can issue a capital call for a closing up until the end of the year. We'll also communicate with you. If it doesn't look like we're going to have a deal in contract relatively soon, we'll release our investors from their capital commitments early. I'm not going to hold you until December 31st, just in case we get something at the last minute. We'll just raise a new fund if that were to happen. Minimum investment amount is $100,000. We have a question on elaborating on LTV versus loan to cost. Yes, so loan to value is the amount of the loan relative to the purchase price. Loan to cost is the amount of the loan relative to the purchase price plus renovations. So the more conservative leverage is to use loan to value, more aggressive is loan to cost. We scaled back to loan to value, again, just for safety, and the less debt, the better in our opinion. Daniel asks if we've been close to winning the bidding on any properties outside of Atlanta, and the answer to that is yes. We're actually circling very close to a couple of other acquisition opportunities right now that are outside of the Atlanta metro. And we also have several leads that are off-market leads that we're pursuing in Arizona and Nevada. We're also reaching out to sellers that we know and institutional owners that we know to look at their exits and what they have coming up in their disposition pipeline. So we've got feelers out all over the place. And, I would like nothing more than for asset number 3 to not be in Atlanta. And there's nothing wrong with Atlanta. We like Atlanta. It's a very strong market. We have a great portfolio there. But we would like to see some geographic diversification out of this fund as well as asset diversification. Are we doing 100%? David's asking if we're doing 100% renovations on the properties or if we're going to do partial renovations and then exit. Well, the answer is a little bit of a hybrid of both. And by saying that, what I mean is we have it in our budget and in our business plan to renovate 100% of the units. And the reason we do that is, again, it's a safety backstop because we don't know what the market's going to do. And if the market turns against us and we have to hold this thing for 10 years and we need to renovate, all the units, we want to make sure that we have the capacity to do that. On the flip side, most of the assets that we've acquired, we've been in and out of in 3 years. And, you don't usually get to all of the unit renovations. So we've got kind of a mix right now, or we have one property we're going to sell next year where we'll have probably renovated about half of the units. And then we have another one that we're selling that will have renovated about 85% of the units. So it really depends a little bit on timing and kind of what the market's doing. I call ourselves a buy and watch investor, where what we're doing is we're acquiring property and we're watching the market for the optimal time to exit. And in my opinion, the sooner you can exit and achieve the results you were looking to achieve, usually the better. And that inflection point, usually somewhere around year 3 to 5. Certainly we want to let the market dictate our answer there. Joe says, if you raise enough capital for a third property, does that mean the portion of the funds not allocated to the first 2 properties are lying fallow and not earning returns? We're not calling for that capital, so it's only not earning a return if you have it sitting in a savings account at 0.25%. In that case, there is that risk. Now, our goal is to have something acquired relatively quickly. One of the reasons why we did the fund and one of the reasons why we're sizing it as we are is we're trying to match it to our deal flow. As I said earlier, we originally already had 3 properties in contract where it's likely that we wouldn't have had any idle ability. I wouldn't be surprised if by October 15th we don't already have another property ready to go, or at least very shortly thereafter. So hopefully it's not going to be very long before we find another one. Our deal flow is pretty robust. And as I mentioned before, we're also using our exits for next year as leverage with brokers to bring us additional off-market opportunities by dangling that carrot of getting the listing. Do investor returns get diluted when more investors are added? No, we're not adding more investors. So unlike most funds where they have an open period where you're raising funds for perhaps like a year, we're not doing that here. We're treating this more like less like a conventional fund and a little bit more like a 2-asset syndication with some dry powder to collect a third or perhaps even a fourth. We're not looking at this as an evergreen vehicle where investors would get diluted and we'd continue to raise capital over a long period of time. We've done those in the before. They're really not that fun to manage, but they can be a really good vehicle. We might do something like that next year, but we're still trying to figure out how we would do that and still make it really advantageous for the investor. Let's see. How about what were the income decreases on our properties during the Great Financial Collapse, and how did they compare with the 85% default ratio you're underwriting to here? Oh man, we had some actually that were totally fine, which was interesting. There was a study done recently. Bob was telling me about it the other day. Looking at the Great Financial Collapse, the percentage drop of income during the Great Financial Collapse in multifamily, and it was really very minimal. It was like 5% or some amount like that. Now that experience, of course, was different all over the place from property to property. And I'll tell you an experience I had. We had one property. I used to joke that half the units were empty and the other half weren't paying. That property literally had no money left over for debt service after the expenses were paid. And I actually made the $15,000 a month mortgage payment out of my own pocket so that my investors wouldn't lose their investment. I did that for about 3 years. So it can get really ugly, and believe me, I know what pain feels like. We do everything we can to avoid that pain. We're trying to select higher quality assets that we think are going to survive better in a downturn. We're taking a defensive position, from a debt perspective. Banks are probably like your biggest scaredy cats out there, and banks tend to use 85% as a rule for default ratios, where when they climb above 85%, then things start to look risky, and below 85% less so. And so, we're sitting 85% is our max that we're looking for in year one. We're actually fall a little bit below that on the assets that we're acquiring for the fund. And, by year two, we're significantly below that. And we think that's where our margin of safety lies. The other thing to keep in mind is, our default ratio in year one, while it's approaching that 85% break point, it's also based upon income that we're underwriting very conservatively with about 30% economic vacancy factors. So, don't think that if income, or if the property ends up 15% vacant instead of 5%, that brings you to the 85%. It's not that at all. We actually would have to do considerably worse than that to get to that 85%. Other than 4 single multifamily assets sold from 13 to 18, how many multifamily units did Praxis own during 2000 to 2014 period? How many units? I think it was only around 100. We didn't own a lot through that period. I sold out of a lot of assets in 2004 because the market looked like it was not very healthy. So from 04 to 07, I was doing very little, kind of twisting my thumbs a little bit and getting frustrated that there was really nothing out there to buy. So we really scaled back. I did have about 100 units in our portfolio left, during that period of time, and it was certainly an interesting ride, to say the least. But certainly teaches you a lot about navigating market cycles. One thing I think is important to note is that, anybody that's been in this business less than 10 years has only seen an up market cycle, doesn't even know what these down cycles can look like, or especially hasn't felt that pain personally and had those uncomfortable conversations at the dinner table about, what are you going to do? And, I've been there and done that. What are the projected hold times and exit strategies for assets in the fund? Projected hold time is 3 to 5 years. The fund has a 5-year life cycle as built into the fund documents. We also have 2-year extension options. If you add those on, that gives us a total of 9 years. To go out longer than 9 years, we have to go to you guys as the investors for a vote. If majority votes to hold longer, we can do that. Again, our goal is to be out as soon as possible. As soon as the market dictates that it's safe for us to get out and we can produce our returns, we're out. I'd like to be out in 3. I always say we sell in 3 years if we can. We sell in 5 years if we need to. We sell in 10 years if we have to. Daniel says, is all investor funds immediately called? Yeah, we covered that one. Will later investors be truing up their entry price? There won't be later investors. Again, we're going to close the fund as soon as we raise our initial tranche. Does our in-house property management structure include on-site property managers, or do you work with local partners? No, we have employee staff at all of our properties. Our property management company is over 50 employees now and growing. So we have our own team at every property we own, and then our executives are on those sites on a regular basis. This allows us to have complete control over the corporate culture and to set all policies and make all personnel decisions. And believe me, it makes a difference. When you go to our properties, those leasing consultants will stand up and greet you. That's our corporate culture. Billy asks about if we can talk more about future capital calls and whether participation is required. Yes, participation is required up to your capital commitment. So if you say, I want to invest $100,000 and we only call for 50, it is required for you to contribute the other 50. But if you have contributed your 100,000 that you agreed to, and we issue a capital call for you to go above your capital commitment, you are not required to fulfill those capital calls that go above your capital commitment. Now, the only reason we would do something like that is if there was some kind of trouble on the horizon. We wouldn't do it to acquire another property. But if, for example, the bad economic cycle, you run out of cash, and you had to issue a capital call to investors. This does happen with some investment funds out there. We've never issued a capital call in the 30 years I've been in this business. But if we had to and you did not want to comply with it, we can raise money from outside investors and you would be diluted. That's what the partnership agreement says. And that's pretty common in the industry. Actually, I think it's lenient. There's some partnership agreements that will say that if you don't contribute money on a capital call even above your capital commitment, then you'll be penalized or you could forfeit your returns and all kinds of craziness. We don't do anything like that. Let's see, we've got a couple saying that we've answered them. We're just about out of time. I've got just a couple quick questions. I'll try to get to those. And then if there's any additional questions that come in, we'll answer those via email. What are the advantages of investing in multifamily fund versus individual property investments? I think it's just simply you get that diversification, one investment, multiple assets. The other advantage is you don't have to worry about watching your email for our next offering and being afraid you're going to miss it. You're in, and the next asset that we acquire, you'll be in that too just by default. I think that's the biggest advantage. A little bit less cost. You get some cost savings because we only have to do one offering, and that cost savings, of course, is passed on to you because you're the investor and you get most of the cash flow. Can you add more to your commitment? No. Once you've agreed to commit, whatever it is you've agreed to commit, we won't be doing any follow-on commitments. Although, next year we'll probably raise another fund after this one has been fully allocated and we've acquired. So certainly you could invest in our next fund, and we hope that you do. Can you verify this is accredited investors only? This is a 506B offering. It is not advertised, so we are allowed to accept up to 35 non-accredited investors as long as we have a pre-existing relationship with you. If we don't have a pre-existing relationship with you, we cannot accept an unaccredited investor in the investment without that pre-existing relationship. And that just means that we've had to have a conversation with you, and if you've talked to Bob before and already had a call with Bob, then yes, you can participate. Are we audited by an external auditor? No, we are not. We never have. Those audits cost about 25 grand, and we've talked to some investors. Obviously you guys foot the bill for that, and the consensus so far has been that it's not worth the cost. So we're not planning on doing it in this one either. Will all new deals that you come by go in this fund first before setting up another standalone deal? Yes. Anything we buy, as long as this fund still has dry powder, it's getting purchased in the fund. Is it only open to accredited investors? Great question. Just answered that one. Waterfall pref structure change based on the investment amount? No. Your waterfall is the same no matter how much you invest. And how does the pref payout work? The pref payout means you get 100% of distributable cash flow until you've reached that preferred return. So let's say it's an 8% preferred return. You get all cash flow until you reach an 8% cumulative. And so what we do not do, you'll see sponsors out there that do this. They'll pay you 8% no matter what. And so even if the property is only throwing off 4% cash flow, they're paying you an 8% distribution, which on the surface sounds really great. And you're like, all right, I'm getting 8%. These guys are doing a great job. They're meeting their projection. But if the property is only throwing off 4%, all they're doing is returning your own capital back to you. And so we could raise more money from you and then just simply write you a check back to make up the difference between what the property produces and the 8% return. But we don't do that. Instead, we raise what we need. We have a good cash reserve, but we only distribute what the properties are generating. So if the property generates a 4% return in year one, you get 4% in year one. If it's 8% in year two, you get 8% in year two. If it's 12% in year three, you get 12% in year three because we still owe you 4% of the shortfall from year one because you only got 4%. So it's cumulative. You get everything until you get 8% cumulative all the way from the initial time of your investment. That's the way the pref payout works. I think you mentioned the cash flow might not be 7 to 8% in year one. Is the delta made up in year two? Same answer as before. The delta is made up. It might be in year two, it might be in year three, or it might be on sale. And this happens a lot in these funds where there's still accrued, undistributed preferred return at the time of the sale, and the investor gets first claim on cash flow until that's made up and you're made whole on the 8%. Then the remaining cash flow after that drops to the next split tier where we can participate. Can you mention the properties that you're potentially looking to exit next year? Yes, Terra Hill and Birch Run and Turtle Creek are all properties that are on our radar to exit for next year. When is capital returned at disposition or refinance? Both. If we do a cash out refi, which would be the plan at year three, we would return capital at year three to the extent that we have it available from that cash out refi. Otherwise, the rest of the cash is returned at disposition. I have a question from one of our current investors wondering how our Houston property is doing with the big storm. Any flooding? We've had no reports of flooding at Carriage Place so far, and fingers crossed we don't. We managed to survive Hurricane Harvey without any flooding, so hopefully the same thing goes here. Forrest wants to know if Bob is the most handsome person in our group. Only when he's wearing a Hawaiian shirt would be my answer to that, I guess, but I'll let you be the judge, Forrest. Josh wants to know, when you are looking to exit the properties, will there be an option for a rollover to another fund, thinking about 1031 or the use of an UPREIT to avoid taxes? 1031 likely not to work. The only way we can 1031 exchange fund assets is if everybody in the fund stays in and does a 1031 exchange. And believe me, when you have 100 and something investors, getting everybody to agree to that, nearly impossible. So we don't expect 1031 to be an option. UPREIT could be an option. However, we doubt it, but we haven't ruled it out. UPREIT could be an option. But our primary exit strategy is an outright sale to third-party buyers. See, do we offer 1031 exchange options into future deals? We do have the ability to accept 1031 exchange funds into new deals on a case-by-case basis if the fund amount is large enough. It's a very complex process to execute. So if you have a big investment you want to put in a 1031, let Bob know and we can talk about it and see if we can make that work. We're doing one of those right now with an investor, but it really is case by case. Daniel asks, any thoughts on what the next downturn may look like? Well, I think it could take a lot of faces, but I don't think it's going to take the same face as the last major downturn. My sense is that a downturn is going to be a lot more macroeconomic and less real estate, but it'll probably result in a leveling of prices, maybe a leveling of rents, perhaps some cap rate decompression where cap rates come up a little bit, which effectively means that income streams are worth less than they were before. But we're already planning for that. Our sale cap rates are higher than our entry cap rates and higher than what we think market cap rates are today. So we're kind of already planning for that to happen. Will we continue to take sophisticated investors as opposed to accrediteds? We will for now. So far, all of our offerings are still 506B, although we may do a 506C next year, which would eliminate non-accredited investors from participating. Having said that, we have a vehicle that we can implement that would still allow non-accredited investors to participate. And when we get that far, we can talk more about what that might look like. Let's see. Are we seeing too many dumb buyers yet? The answer is yes. We're seeing a lot of them, which is why our hit rate on marketed deals is almost near zero. Almost all of our acquisitions are off market, and very little success on marketed deals because we're just getting outbid to the moon by other buyers, but that's not slowing us down. Is Bob wearing a Hawaiian shirt right now? The answer is yes. You got to be kidding. Always. With the cash out refi, how long will investors still receive returns after they receive all their capital? Forever. When we do a cash out refi and return capital, it does not change your ownership percentage in any way whatsoever. Your ownership percentage remains as it was. We return capital on a pro rata basis, which means if you contributed 10% of the fund money, you get 10% of the cash out distribution. Your ownership percentage remains the same as it was relative to other investors before that. The only thing that changes is the preferred return hurdle tier. It changes composition somewhat, because now instead of, like, let's say we had 20 million and now we have 10 million, we're only distributing 8% on 10 million instead of 8% on 20 million. So the pref tier gets absorbed much quicker, but that doesn't mean that anything really happens. What happens with the balance of the money is it just drops to the next hurdle split. So it doesn't change in any way the distributions that you're entitled to, other than reducing the amount that's required to get you to the 8% return. Is 3 to 4% rent growth assumption aggressive in this market? It depends on where. If you're investing in Kansas City or something, I would say, yeah, it's probably really aggressive. But when you're investing in markets that are, historically experiencing 10% rent growth and are forecasted to achieve 5 and 6% rent growth, no, I don't think 3% is all that aggressive. What we don't do, let me tell you what we do and what we don't do. What we do is we look at the economic experts and, the economists. They predict on a submarket by submarket basis what they think rent growth is going to be in those markets. And we look at that and use that as a guideline, and then we pull back from their estimate to be more conservative than what they're reporting. And they tend to report fairly conservatively because they don't want to over project. And then people are calling them up later saying, well, gosh, you said I was going to get 5 and I only got 4. So they kind of, like, if they think it's going to be 5, they're going to say 4. And when they say 4, we're going to say 3. So we think we're being adequately conservative. When is closing for these 2 properties? Does it make a difference when the fund closes? The closing date is currently set for the end of October, which is why we set the closing date for the fund to be October 15th. So we'll take commitments until October 15th, and then we shut the fund down. We issue the capital call. You all send your money in, and then we close on those 2 assets at the end of October. So I ran out of questions. We ran over just a little bit. Thank you, all of you, for sticking around. I noticed a lot of you stuck around all the way to the end. Again, webinar replay link will be emailed out in a couple hours. You can watch any of this again if you wish. We certainly appreciate you being here for this webinar and for your participation and your trust in Praxis. We don't take your trust lightly, and let us know if you have any questions or concerns. And Bob is always available to take your verbal and written commitments. Thank you guys so much, and have a wonderful day and a wonderful weekend.